I'm very grateful to Professor Vogt for her introduction about the legacy of Hermann Otto Hirschfeld. As Wolfgang mentioned, I never got a chance to use those tables. I think I came out just after the times when computers became sufficiently widely available that the tables weren't really taught. But I do feel that we've lost something. I mean, if you think about it, the computers are effectively using the same series algorithms. So we've kind of outsourced to MATLAB or Mathematica the business of producing those numbers for us. And I think we are not taught anymore how those numbers are coming about. And you just plug in and plug that into MATLAB and you get a number, and that gives you the size of that tail of that distribution, and you're done. And you're really trusting whoever at MATLAB or Mathematica or whichever algorithm or software you're using basically did the right thing in terms of giving you an approximation that's valid for the type of parameters you're using and the types of parameters you're constructing. And it's I have a sense that this is something we've missed. And Peter was kind enough to mention that I was a mathematics undergraduate, and my favorite topic in mathematics was always real analysis. So certainly I'm very fond of properties of series and when do they converge, and when is this reminder small enough that you can sort of get rid of it. So there's some interesting beauty in this that I think has been lost in this business. Now, in terms of what I'm going to talk about in this first lecture, the quote that Professor Vogt gave at the end of her introduction from that 1980 presidential address by Hermann Hirschfeld, and especially on the role of data and imperfections of data, really serves as a perfect introduction for what I'm going to describe. And it was certainly very prescient that that he was quite concerned about. Obviously, the quote makes it clear that he was concerned about pitfalls in macro data and pitfall in survey data. But to some degree, today we tend to be more concerned about financial data, or really finance without even data altogether these particular days. But as far as financial data is concerned, the topic that I'm going to cover over the next hour and a half is really very much in the spirit of data being imperfect and what to do about it. When HOH basically talked about the problems of data acquisition and said that the problem of data acquisition is, I believe, the critical issue with which most professional statisticians must deal. And again, they are faced with the question of sort of where can I get data or information? The where can I get data or information is something that probably is no longer a problem for us. In fact, it's probably too easy to get data, and it's probably so easy to get data. You just click a few things on the web page, you wait 2 minutes, the web page refreshes, and you've got a few megabytes of data that you just save on your desktop, and then you're done. To the point where we probably don't get a chance to think about where the data came from, how imperfect it might be, how was it generated, and so on. So when he says it's distinctly risky to just identify your data source and then blindly proceed to use it, it's also vital to have information on the limitations afflicting such data sources, limitations both with regard to coverage and content errors. Well, that's what he wrote in 1980, and that pretty much is where I'm going to begin in terms of addressing the imperfections in high-frequency data and how statistically we can deal with estimating volatility when high-frequency data are inherently imperfect. And they're imperfect because of the very mechanism of trading. The fact that we trade in certain ways, the fact that we trade in certain ways, that exchanges take place, that that assets get bought and sold at different prices, the fact that typically market makers tend to engineer price movements that benefit them by moving prices in certain directions at certain times, the fact that trades of securities tend to contain different degrees of information because some of them are more informative than others, because some people are informed when they trade, some people are simply noisy agents when they trade. The fact that There might be a strategic component to the way an order flow is managed. All of these things tend to mean that when we think about a price for an asset, at least under a microscope, the notion of a price is not something that's as clear as it is in a theoretical model. And in a sense, that's very much what HOH was really referring to in his presidential address. You just really have to be careful. And as I said, it's that's really the first slide in my lectures. It's all about incorporating that noise term mu in the price. So I'm going to think that the price you're observing, and again, that's really only true at high frequency. If you're thinking about daily returns, daily log prices in finance, certainly the noise component in them is small enough as to probably be negligible, at least for the type of things that are heavily traded. But at high frequency, there's a lot of market microstructure effect that might be informational or not, that might reflect, again, frictions in the trading process, or may reflect more economic information issues. And so I'm going to think about a situation where the observed transaction price, X tilde, is going to be some theoretical dream price, if you like, X, plus a noise component. And it's a model that's going to be additive in log terms. So in price themselves, it's a multiplicative error model. So you effectively are going to have, just like there is a volatility that comes from X, there will be an additional volatility that comes from U. So you might think of perhaps, the standard deviation is 30% per year for the price itself, but then there are a few basis points here and there that make a difference. And what we're going to be concerned about is what happens if that's your data, but you're trying to learn something about X. You're trying to estimate a component of X. And typically in finance, we realize that at least at high frequency, it's very hard to say anything sensible about expected returns. So it's very hard to say anything sensible about any component of the drift. So mu t here is something that we'll get rid of very quickly, because over those horizons, it's effectively impossible to say anything about mu. However, it's quite possible to say quite a lot about sigma, about the sigma process. And we're going to think about sigma as either something that's parametric, so perhaps there is a dependence in the state, X, and sigma is a function of the state and some parameters, or we'll think of what I call the non-parametric situation, where sigma is itself a stochastic process. So you might think of perhaps another equation like this one that represents the evolution in time of sigma. Now, in terms of the data you have typically, and that's where you have high frequency data, I'm going to imagine that we're observing that process on a fixed time interval from 0 to capital T. And of course, we're only observing discrete data. So we're only observing discrete data that are going to be, for simplicity, assumed to be sampled every delta units of time. So I'm going to have n data points sampled every delta units of time on a time interval from 0 to capital T. And I'm going to think of this as being a high frequency situation in the sense that delta is going to go to 0 asymptotically. So the asymptotics are going to happen when you're sampling more and more frequently. So say you're moving from hourly to data every 5 minutes to every minute to every 10 seconds, every 5 seconds, and the like. So those are the kind of asymptotics we're going to be interested in. And then we're going to distinguish what happens when you're trying to estimate, learn some information about sigma, either sigma as a process or sigma as a parameter. We are going to try to learn, in the case where sigma is a process, we're going to try to learn something about the quadratic variation of X, which is the integral from 0 to t of sigma squared dt. So you might be wondering, why is this a relevant quantity? That's a relevant quantity because, for instance, if you think about pricing an option on this process, then given the path of volatility, at least if the sigma process is independent from the X process, the price of the option would be, in this case, the expected value of the Black-Scholes price evaluated at the quadratic variation from 0 to t, with the expectation taken over the possible paths of sigma. So that's certainly one reason why this is a relevant quantity, but it's also a relevant quantity if you're doing portfolio management, if you're doing risk management, if you're trying to learn something about the volatility of the portfolio that you are holding. So that's the quantity. That's the quantity we're trying to learn about. The problem is that quantity is defined for x, the true price, but we're not observing x. We're observing x with some error. And if there were no error, or if you were willing to assume that there were no error, one particularly interesting aspect of continuous time models, and in particular diffusions, such as the one that is written up there, is that in the limit, when you're sampling more and more frequently, the discretization bias disappears, and in fact, you end up being able to learn about the quadratic variation perfectly in the limit, which means that you can fairly easily construct estimators, realized volatility would be one of them, that converge effectively to the quadratic variation without error in the limit. So in that idealized situation, what you want to do is in fact sampling as often as possible, because as you will see in a moment, the error you're making is directly proportional. The error, by that I mean the standard deviation of the estimator, is directly proportional to the sampling interval. So reducing the sampling interval helps you. Unfortunately, and that's where the realization that the data are noisy is going to matter, the situation is going to be dramatically different if you actually properly account for the imperfections in the data. And if you start accounting for market microstructure noise in the data, then in fact what you will see quite easily is that there is now an optimal sampling frequency, which is finite, which means that in fact, even if you have a lot of data at very, very high frequency, perhaps you may not want to use all of it. And the intuition for this is quite simple. If you think about a log return, so the return you earn from holding an asset over a very short time period. So just imagine that, for instance, you're doing what's known as stat arb in this business, or statistical arbitrage. It's kind of interesting is that, yes, it is statistical, but as we've learned, there's certainly no arbitrage in this. It's a trading strategy, but it's not an arbitrage in the proper sense of the word. But anyway, it's known as stat arb. So you're buying and selling things over relatively short periods of time, and you're doing that at very high frequency. So think about the return you earn over a small time period delta. There are two components to that return. There's one component that comes from a true price movement. And that's a component that comes from x in my notation earlier, moving. Now, over an interval of time delta, in probability, the change in x is of order square root of delta. And that's because I have a Brownian motion. If I had a more general Levy process, the change in x would be of order delta to the 1 over beta, where beta is a number between 0 and 2. The point being that this is a quantity that is small when delta is small, which makes sense. It says that if you're waiting for, if you're just holding an asset for 5 minutes, the true price, the probability that the true price will move a lot over 5 minutes is relatively limited. It's of order square root of delta. Now, at the same time, if you're holding the price for 5 minutes, you're buying and selling the price at both ends. Well, you're buying at the beginning and selling at the end. But every time in this very simplistic model, every time you're transacting, you are effectively putting your hand into that bag and you're getting a random number out of it. Okay? So you are effectively drawing a random number for every transaction. Now, whether those two transactions are separated by 5 minutes or 5 days or 1 year, it doesn't matter. There are still two transactions. So you still have two transactions that effectively each generate a very small error, maybe something of the order of a few basis points. But if those two transactions are separated by a long period of time, the price has had a lot of time to change in a meaningful manner, so that those two changes are relatively small relative to the actual error that you're making. So if you're thinking now in terms of a signal-to-noise ratio, the signal-to-noise ratio is actually very large when you are waiting a long time. But conversely, when you're waiting a very short amount of time, your signal-to-noise ratio deteriorates quite dramatically, because you're still making the same error whenever you're transacting. Perhaps there was a bid-ask bounce or something like this. But the amount of true price information there is over a very short period of time, over that short log return, is actually very small. So in a sense, now if you're familiar with sort of the statistical literature on measurement error, this is an unusual problem. It's an unusual problem because in the high frequency limit, the noise swamps the signal in this case. In the high frequency limit, if you wait 10 seconds, it's very unlikely that over 10 seconds what you actually saw was a true price signal, and it's very likely that whatever change you saw was simply a reflection of the market microstructure noise. So the frictions in the trading and so on. But it's very unlikely that there was any true information in this. Now, so that effect would by itself say that you should not probably expect to sample too frequently, because that simple signal to noise ratio argument would make it unlikely that you would want to sample too frequently. Now, running counter to this is a basic principle of statistics that we all teach in Statistics 101. I'm not sure what is the numbering system for courses in Germany, but Statistics 101 would be sort of the first year statistics course that you teach to every student, that every student has to take. And one basic statistical principle we teach is that, since I guess this is a church or a former church, maybe I should try to phrase it as, thou shalt not throw away data, would be the appropriate way of phrasing that simple statistical principle. That if I give you a lot of data, even if the data is very imperfect, you should try to use it in some way and not throw it away. So picking data every here and then and saying, well, that data was noisy, so I'm not going to use it, or I like that data better, or I like this data better. There's a simple statistical principle that at least if the data are IID, that the standard error that you're getting from estimating anything from data typically decreases like 1 over square root of the sample size. And that's a powerful principle that's hard to fight. So, you get more data, it's going to be better. If you're doing a survey before an election, if you get more people, it's other things equal, it's going to be better. You're going to get a more accurate answer. So running counter to this suggests that, in a way, there might be an optimal combination of these two things. And what we'll show, and I'll start with that, is that these two effects compensate each other. So the signal-to-noise ratio deteriorates when the time interval gets too small. But then having more data is more useful, and effectively those two effects compensate each other and result in a finite optimal sampling frequency. Now, even if you were doing this, you're still throwing away a large amount of data. Now, if you're familiar with the realized volatility literature, which has been quite popular in empirical finance over the past few years, you probably have heard or used data, high-frequency data, that may come to you sampled every few seconds for the most liquid stocks on the DAX, or certainly for if you are looking at currency futures between the euro and the dollar or the euro and the yen, you might be looking at data that are sampled at incredibly high frequencies for currencies, certainly much more often than once a second. And yet, when people who do realize volatility tend to calculate their realized volatility estimates, they will typically do those at 15 minutes or 5 minutes, 15 minutes, 30 minutes, some numbers in this range. And that amounts, of course, to throwing away a lot of data. And that sort of involves sort of throwing away a whole lot of data. And what I'm going to show you is that in the parametric case, a simple exercise in modeling the noise explicitly through the likelihood of the observations actually restores that first-order statistical effect that you should use all the data, or equivalently sampling as often as possible is optimal. And in fact, you might ask then, but how about model risk? How about the risk that, by doing this, you're introducing a model for the noise, and your model for the noise may be wrong? And if your model for the noise is wrong, maybe you are actually doing more harm than good by correcting explicitly for the noise. And that's sort of the classical argument between parametric and non-parametric statistics. If you're parametric, if you're willing to tie your hands with an actual model, then you can do lots of things that look pretty good. But then if the model is wrong, your estimate may be off. Well, in this case, there's a surprising result that, in fact, this is true even if you misspecify the distribution of U. So even if you're using the wrong model for U, you're still better off. You're actually still better off, within reason, of course. The wrong model, I don't make that precise, but you're still better off than not doing it and sampling at a lower frequency of sort of 5 to 30 minutes, say. So this robustness really argues for incorporating the noise term when one is estimating those continuous time models with high frequency data, even if you actually do not know about the actual distribution of the data. And we will also sort of look at sort of the same questions when the observations are sampled at random time intervals, which is obviously an important feature in financial data because the amount of time between observations is not constant in general, at least within again, some restrictions on what you mean by the randomness of the time intervals, the same results will actually carry through. Then I'll study the non-parametric or the stochastic volatility case, which is one where you will now tend to estimate the average volatility or the integrated volatility from time 0 to time t. Now it's a random variable. It's a quadratic variation of the process. And what I'm going to show then is that ignoring the noise in this situation is actually even worse than in the parametric case. Because in the limit at high frequency, you will in fact not estimate the quadratic variation, but you will estimate something that turns out to be directly an estimate of the variance of the noise. So in fact, it's a consequence of the fact that in the limit, in that situation, because the noise swamps the signal, the noise completely swamps the signal, so you end up effectively estimating the variance of the noise. But we'll be able to turn that to our advantage by using that limit as a means of correcting for the estimate for the impact of the noise, and in fact coming up with a bias-corrected estimate of the integrated volatility that makes sense, that makes use of all the data, and that will use both subsampling and averaging. Okay, so the outline for this first lecture, we'll be looking at the parametric case first, which with a simple Ito's lemma transformation can be reduced to having a constant model, a constant volatility. And I'll show you first what happens if market microstructure noise is ignored. Then I'll show how to correct for the presence of the noise using the likelihood. And I will then turn on to the non-parametric case of stochastic volatility, looking again first at what happens if the noise is ignored, and then how to correct for the presence of the noise, and that's based on using subsampling and averaging. So let's take a look first at the baseline case, of having a constant sigma and no market microstructure noise. So U is 0 in this case. Remember, U was my noise, and X tilde are the observed prices, the observed log prices. So the observed log returns, which are the Y's, are going to be the first differences of the X's, since the X's are log returns, log prices, so the log returns are the Y's. In this case, if U is 0, sigma is constant, you have a very simple situation. This is a Levy process. It turns out to be a Brownian motion, but it really is a Levy process. And sigma, which is at that point the scale parameter of that Levy process, is such that it's a Levy process. You have IID returns. And in this case, they are normal because it's a Brownian motion. So they are normal 0 sigma squared delta. If you want to estimate sigma squared in this case, anything you do that's sensible, whether you, for example, use the sample variance of those returns, or you use GMM, the generalized method of moments, or an estimating equation, as these things are called in statistics, using the variance as a moment function, or whether you do maximum likelihood, you're going to end up with the same answer, which is the estimator that's over there, and that's nothing else than the realized volatility. So it's simply the sum of the log return squared. And that's usually the typical notion of volatility that most people would use when they look at high-frequency data. Now, what's the behavior of that estimator? It's fairly straightforward. The behavior, the asymptotic behavior, not only is it consistent, but in distribution, the behavior is given by the convergence in distribution that you see up there. And what I will highlight is that the asymptotic variance, when the asymptotic variance is proportional to delta. It's 2 sigma fourth. Why 2 sigma fourth? Because those returns are normal. Since they are normal, 2 sigma fourth is effectively the fourth moment of that normal, so it's the variance of the variance. So it's quite natural that you would get 2 sigma fourth in there, but then it's multiplied by delta, the time interval that you've used to discretize things. So as usual, in this case, you have a consistent estimator, you have a variance that's proportional to delta. What's the message? The message is quite simply to take the lowest delta you can pick. So if I give you data that are sampled every 5 seconds, you're going to be better off than if I give you data that are sampled every 15 seconds, okay? Which would then be better off than data that are sampled every 5 minutes. So the message is use all the data you have at the highest possible frequency. And that's what's going to be optimal. Now, people who do realize volatility are, of course, aware of this, but they're not naive. They're not naive in the sense that they realize that this is a theoretical result. It's a simple theoretical result for that matter, but it's not one that carries very far because really the notion that there is no noise is really not a realistic one in the type of data we have at high frequency in finance. So what happens if the observations are noisy, but the noise is ignored? So now you're ignoring that noise even though the observations are noisy. So now the U's are there, and I'm going to assume that the U's are also IID. Whether that's realistic or not is something I will discuss later on, but they have mean 0 and they have a variance which I will call A squared. So now the U's are there, but you ignore their presence when estimating sigma squared. So in other words, you're thinking that you have the same likelihood as before, even though the true structure of the log returns is now given by the equation up there. And the equation up there shows you that instead of having IID returns, your returns now under this very simple model is an MA1 process, or a moving average of order 1. Effectively, what's happening is that the noise is introducing correlation between adjacent returns. Okay? So now you're looking at sort of correlation between adjacent returns, but then returns that are at least one period apart are uncorrelated. Okay? So 2 successive returns are correlated, but returns that are at least one period apart, there's no correlation. So if you think about what would the autocorrelogram of such a process look like, what are you going to see? You're going to see that obviously the correlation of contemporaneous returns is 1. That's always the same. You know, those returns are not schizophrenic, so they are perfectly correlated with themselves. And then at the first order, there is an autocorrelation, and then at the second, third, fourth, fifth, etc., there should be no autocorrelation. Furthermore, you should expect the first order autocorrelation to be negative because you've taken differences, and what you realize is that the differences is coming from the term minus UTI minus 1 being correlated with plus UTI minus 1. So you should expect that term, you should expect that autocorrelation to be always negative because you are taking minus 2 times a variance, minus a variance, basically. So you're expecting the autocovariance to be proportional to minus A squared and then the autocorrelation to be negative. Here is one stock from the Dow Jones. That's AIG. This is well before they became famous for other reasons, or rather infamous, I should say. So this is, you know, this is work that we did sort of 4 or 5 years ago. So this is absolutely, this is just the stock. This is just a plain old stock before they had to take $100 billion from the government and so on and so forth. So, you know, it just happens that, you know, we've looked at the Dow Jones stocks, and, you know, it's a stock in the Dow Jones that starts with an A. So at the time, it looked like a relatively safe choice of something. You just pick, you know, the Dow Jones. There are 30 of them. I pick A, right? The first one in there in the alphabetical order. It turns out now this looks very suspicious. Why were we looking at AIG back then? But that's the only reason. That's the only reason. And what do you see? So pleasantry aside, what do you see in the data? You see something that looks awfully close to an MA1, to the autocorrelogram of an MA1 process, with the order 0 being 1, of course, the order 1 autocorrelation being minus 0.4, and then everything else being pretty much 0. So you look at something that looks awfully close to what you would get if you had that additive noise, model for that particular thing. You'd get exactly sort of the autocorrelogram pattern of an MA1. So certainly you are not getting what you would get from an IID process. An IID process would give you 1 at order 0 and then 0 everywhere else, because then they should be uncorrelated at all lags. And here you have this very strong negative first order autocorrelation. Now, when you have that, that opens the door for effectively first seeing what happens to the model, to the estimate, to the uncorrected estimate of sigma, so the plain basic realized volatility. What are the properties of that estimator if the data generating process is the MA1 process that I've just written? So in other words, what I'm going to do, what I mean by ignoring the noise when the noise is present, the ignoring the noise part refers to the fact that I'm still using the same estimator I would have used, but then the fact that the noise is present means that I'm going to now calculate the properties of that estimator under the assumption that the noise is present. Okay, so it's a bit of a strange calculation. It's sort of saying, because you could immediately reply, then if you know that the noise is present, why do you use the uncorrected estimator? And my response to that will be, well, that's what people are actually doing. People are actually using that uncorrected estimator despite the fact that the noise is present. So what I'm going to show you is that this is dangerous. Now, why is it dangerous? It's dangerous because you see in the first equation on that transparency, you see that when delta goes to 0, the bias blows up. Okay? So it blows up, and that's exactly what you would expect from the intuition I gave at the beginning about the signal-to-noise ratio deteriorating as the sampling frequency increases. As the sampling frequency increases as delta goes to 0, the signal-to-noise ratio deteriorates. That generates bias in the estimator, and you are clearly not estimating what you think you're estimating. In terms of the variance, there are two effects in the variance. The two effects in the variance are coming from both the discretization error, because you are effectively using discrete data, not continuous data, to estimate that continuous parameter, as well as the presence of the noise. And those two terms, certainly, if you observe things on a long enough time interval, if t grows, you can kill the variance of that estimator. And that means that, at least in that sense, there is going to be an asymptotically optimal sampling frequency. That says that for a given t, for a finite t, for a given t, so a given length of observation, and maybe I have a day worth of data, or I have a week's worth of data, or a month's worth of data, something like this. That's my 0 to t. Over that time, there will be a unique minimum in delta for the root mean squared error of that estimator, which is one criterion function like any other that you might use. And there is a simple formula for this, to the extent that this is simple. In the day of computers, this is simple, but I'm not sure I would want to calculate those 1/3 powers by hand, unless I had really good computers, human computers in this case. But you know, it's a simple enough explicit formula, and you know, I was glad to see that HOH certainly appreciated the usefulness of closed form formulas in that same article that Professor Vogt cited. And at least here is a series expansion of this just so that we can see what happens asymptotically in T. Asymptotically in T, this looks like something that depends upon basically A, which is the standard deviation of the noise, sigma, the standard deviation of the price itself, and T, the length of it. So the more data you have, as T grows, the longer the time interval you want to use. So the less often you want to sample. And then the ratio of A over sigma matters. Basically, the smaller the noise is relative to sigma, the true volatility of the price, the more often you want to sample, which makes sense. Okay? If prices are less noisy, if the observations are less noisy, you want to sample more frequently. As A over sigma goes down, the optimal delta goes down. And this is what this sort of looks like. If you calibrate this to sort of realistic data for different types of assets, you get numbers. You get a curve for the root mean squared error that clearly has that minimum, and with a minimum that with realistic data is anywhere in the neighborhood of kind of 15 minutes to an hour and a half, etc. When you're trying to sample those processes. And intuitively, without having done that calculation, this is what the realized volatility people have been doing all along. They've been taking data from currencies or high-frequency stock data or futures data and calculating the sum of squared log returns sampled every 5 minutes, 15 minutes, 30 minutes, somewhere in that range. That is somewhat arbitrarily. But at least they are certainly not going to the extreme left part of that graph, because you clearly see that that blows up. It turns out that the fact that that blows up will come back to be useful in a moment. But for now, basically, that's what the realized volatility was doing. So here's a table with actual numbers. If you have 1 day or 1 year, depending upon different values, different values of the volatility of 30% for stocks, 10% for currencies, different values you might get for noise. For the noise, you might get sort of numbers that are in the range of 5 to 30 minutes to an hour. So these are this is just a calibration of the formula. This is just what the formula, this is my table, okay? So this is my table that comes from that formula, okay? You have numbers, you have actual numbers that come out of this, but it's a simple enough formula to calibrate on the computer. Now, clearly statistically that's not satisfactory. It's better than being naive about it and say I'm going to do 15 minutes without thinking further about it, without realizing that whether it's 15 minutes or 2 minutes or half an hour or 2 hours depends upon those quantities. But it's not satisfactory because ultimately I would like, if I have data that are sampled every 1 second, somehow I would like to use all my data. And I would need to figure out a way of using all my data. Now, in this case, the answer is relatively simple. Why is it simple? It's simple because, well, if you have an MA1 for the log returns, then instead of using what is effectively the log likelihood from an IID returns process, why not use the log likelihood from the correctly specified model, which in this case is an MA1 process? And that's simple enough. That's a well-understood problem in time series that maybe is in Statistics 102. In the time series course, the first 2 models you typically learn about in time series would be an AR1 and an MA1, right? So you would learn about an autoregressive model and a moving average model. And you know how to write down the likelihood of these two. Actually, surprisingly enough, the AR1 model is surprisingly more complicated to analyze than the MA1 model, even though it's an easier model to understand in many cases. But the MA1 is very simple because effectively observations are uncorrelated after 1 lag. So they are correlated at the first lag and then uncorrelated after that. So in a sense, that makes for a very easy likelihood. Now, to write down the likelihood, though, a parametric likelihood, I'm going to have to assume something about the distribution of the noise, because otherwise I can't write down a parametric likelihood. So let me start by assuming that the distribution of the noise is Gaussian. Now, why do I assume that the distribution of the noise is Gaussian? Well, you will see why in a second. And then you will see, interestingly enough, that it doesn't really matter. So you do that, you write down the distribution of likelihood, and you've got you know, two different parameters that you're trying to estimate, sigma squared and a squared, which are respectively the variance of the true price process, sigma, and the variance of the noise, a. And then you transform those parameters into the parameters of the MA1 model, which are eta and gamma. Gamma is the total, gamma squared is the total variance. So it's the total variance, and eta is the first order autocorrelation quantity. And so that's just a remapping of those two parameters into two new parameters, and you write down the likelihood, and clearly the variance-covariance matrix of those returns, it's a Gaussian likelihood, and the variance-covariance matrix of those returns has terms on the diagonal, those are the variances, and then just terms on the first supra and infra-diagonal lines, but nothing else elsewhere because of that zero correlation elsewhere. Okay, so it's a very simple likelihood, and then the standard theory for MA1 likelihood, you will get, of course, with the correct likelihood, you'll get a consistent and asymptotically normal maximum likelihood estimator for those two parameters. There's a slight delta method transformation that you have to apply to the standard result because the parameters are not eta and gamma, but the parameters are sigma and a, or sigma squared and a squared, but this is all fairly trivial. And you end up with the following result. So now you end up with a consistent estimator, and you end up with a consistent estimator with the following asymptotic variance. That's what AVAR means, asymptotic variance. And you notice that I have a subscript normal there. That subscript normal refers to the fact that this is the calculation of the asymptotic variance, assuming that the noise is normal, which may or may not be true. So there is a possibility that this is misspecified, because in fact, I would not be willing to bet that the noise is normal. I mean, the noise is probably something very complicated that comes out of this very messy interaction between agents with heterogeneous preferences, with heterogeneous objectives, with heterogeneous beliefs, with heterogeneous information. When everything is heterogeneous, why would you expect that things are normal? The process that results from this would be normal, would be kind of strange to get that. So keep in mind that this is potentially misspecified. This said, though, if it is not misspecified, if it is true, then the asymptotic variance calculated on that assumption looks like this. And what you notice is, you know, the term on the diagonals are the asymptotic variances of the estimator of sigma squared and a squared. Now, of course, the estimator of sigma squared now is no longer realized volatility. It's a different estimator because it's the estimator that comes out from the maximization of the MA1 log likelihood. So it is no longer, even though I'm using the same notation for it, it's no longer the same estimator. Now, this is whatever you get to maximize that MA1 log likelihood. But the point is, when you look at those formulas, is that it's very easy to see now that those asymptotic variances are increasing in delta, which means that as you look at them, the answer is that you should use the lowest delta possible, even though the data are still generated by the same process as before. So the signal-to-noise ratio still gets worse and worse as delta gets larger and larger, but now your likelihood incorporates that and corrects for that automatically. So it's a fairly simple answer to that problem that effectively restores the first-order optimality that comes from the principle that I facetiously enunciated as thou shalt not throw away data, and effectively restores that principle in this case. So you want to sample as often as possible. Now, unfortunately, that leaves the door open to the possibility that I was wrong about the model for the noise. And I may have been wrong about thinking of the noise as being normally distributed. So now, before I get to this, let me just note that you can see what is the correction term in the asymptotic variance of sigma squared relative to the no-noise case. In the no-noise case, in the absence of noise, that's what I started with. When there is no noise, you remember that I started with the fact that the maximum likelihood estimator is realized volatility, and that its asymptotic variance I noted was 2 sigma fourth delta, and I mentioned that it's 2 sigma fourth because that's the variance of a normal. Well, that term is still there, but now this is no longer the leading term in the asymptotic variance. So now the variance is actually, after correction, is actually substantially bigger than what the variance would have been, because now the variance is of order delta squared, and obviously it's proportional to A, because if A is 0, if there is no noise, then you actually revert to the no noise case, right? But so the correction term, there is a loss of efficiency which is at order delta to the 1/2. So you lose something, so the fact that the data are noisy clearly extract a penalty out of you. But it's still better than using an uncorrected estimator, which blows up, because that estimator by construction is consistent. So as you sample more and more frequently, you will still converge to the right thing. Now, what if I was wrong about the distribution of the noise? So now to calculate that estimator, that corrected estimator, I had to assume that the noise was Gaussian, but I might very well be wrong about this. So what if the actual distribution of U is something else? What's going to happen in that case? And something interesting, which is a fairly general phenomenon in statistics, is going to matter. Let's suppose that the U's are not normally distributed, but they are still IID with mean 0 and variance A squared. But they have a different distribution. Perhaps they have a distribution with fat tails, for example, okay? Of being, perhaps they have some other distribution, or they have a uniform distribution, or they have an asymmetric distribution. They have an asymmetric distribution between positive U's and negative U's, whatever, okay? But they are still mean 0. That's pretty essential. Basically, saying that they are mean 0 is a fairly mild requirement. Effectively, if the noise did not have mean 0, then whatever component of the noise that is the mean would have to become part of the price. I mean, that has to be in your definition of the price. If every time you transact, the price is systematically 3 cents above what you think it should be, well, then the real price is the P plus 3 cents. So you need to incorporate the mean into the price. So I think that's pretty clear. Now, we can quibble about whether they are IID or not, and I'll come back to that question later on. For now, I'm simply focusing on misspecifying the marginal distribution of the U's. Now, so let's suppose I'm wrong about that, but I still use the same likelihood that I showed you 2 slides ago. So 2 slides ago, I showed you a likelihood that was Gaussian, but let's suppose I'm wrong about that. So that the true likelihood of the U's is something else altogether, but I'm using that that likelihood that I know how to compute because it's a simple Gaussian likelihood, assuming that the U's are Gaussian. What happens in this case? Well, the way you want to think about that problem is, what do you do when you maximize the likelihood? When you maximize the likelihood, you take the score vector, which is the vector of partial derivative of the log likelihood with respect to the parameter values, and you set those to 0, right? That's how you maximize the likelihood. Agree? So that's what you do. Well, here, you still have that function. I'm reluctant now to call it a likelihood because it's no longer the true likelihood, but it's still a proper objective function that is a function of those parameters, and I can still maximize that function with respect to the 2 parameters using the scores L dot sigma squared and L dot A squared. But now those are the scores that came from that likelihood, which may be the wrong likelihood. So in a way, this becomes like any method of moments or GMM problem, and I guess Carl Pearson is often credited with inventing the method of moments in statistics in the 20s and 30s, so this is another connection with your introduction at the beginning. This now becomes a method of moments, or what in econometrics we tend to call the generalized method of moments. This tends to become a method of moments estimator that uses those particular moment functions, that seem extraordinarily arbitrary in this case because they simply came from that log likelihood, assuming that things are actually normal. Now, there's something special about the normal distribution, though. And what's special about the normal distribution is that it depends only on the first two moments, which means that its log likelihood depends only upon the first two moments of the data. Which means that if I get the first two moments of the data right, i.e., if truly the noise indeed has mean zero and variance a squared, the expected value of that normal score, calculated now not with respect to the false distribution, but calculated with respect to the true distribution of the returns, those expected values are going to be zero. So in other words, the expected value of the false likelihood calculated under the true distribution will be zero. The expected value of the true likelihood score calculated under the true distribution is always zero. That's by definition. But in this case, you also have that the expected value of the false likelihood score, by false I mean potentially misspecified. The likelihood score that assumes that the U's are normal, but that expected value calculated under the true distribution of the Y's is always going to be zero in this case, because it only depends upon the first two moments, and I'm effectively getting the right first two moments for you. A consequence of this is that the method of moments estimators of those parameters are going to be consistent. Because if the expected value, effectively, it will be correctly centered. So consequently, the estimators will be consistent. If you've studied GMM, then that's when what do you need to get a consistent GMM estimator? You need that the expected value of the sample moment be indeed equal to the moment function. In this case, it's a score, so the expected value is zero, and that's all you need. So that means that using the score from the potentially misspecified log likelihood as a score, I'm getting, as a moment function, I'm getting a consistent estimator. Now, I may lose in efficiency, because a GMM estimator will typically always be less efficient than a true MLE estimator, and this is no longer MLE. But this is a fairly arbitrary GMM estimator that turns out to be actually consistent and very easy to compute because we've actually already computed it. So the effect of the misspecification in this case is going to lie in the asymptotic variance of that estimator. And here's what we get. What we get is that you might have wondered earlier in my talk why I introduced the cumulants of another Pearson construction, why I introduced the cumulants of that distribution function of the U's in calculating these things. The reason being that by using the cumulants, you can express everything in terms of deviations from normality. Because if you calculate the cumulants, the first one will get you the mean, the second one will get you the variance, the third one will get you the deviation from the skewness of a normal, which is 3, the fourth one. The fourth one will get you the deviation from the kurtosis of a normal, which is 2 sigma fourth, etc. In other words, if the higher order cumulants are 0, the cumulants of order 3 and above, then in this case that would match into a normal distribution. So by using cumulants, we are actually able to express everything in terms of how far they are from a normal. So if you set cumulant equal to 0, in this case everything is a function of the cumulant 4, which is not surprising because we're estimating variances, so you want fourth moments. You're going to get fourth moments in there. But with everything as in terms of cumulants, if the cumulant is 0, you get back to the previous case. And indeed, the thing is nicely additive in that A var true. So what is A var true? Now that's the asymptotic variance of the same parameter, of the same estimators we just defined, but calculated now under the true distribution of the U's, whatever that is. And it turns out that the only aspect of the distribution of the U's that matters is its fourth cumulant. Is equal to the asymptotic variance normal, which I just showed you earlier, the one calculated under the assumption that you have a normal distribution, plus a correction term. That correction term is proportional to the fourth cumulant of U's. But then you notice something interesting about the matrix in front of that cumulant, and you notice that for the estimator of sigma, which is the term 1, 1 in the matrix, the upper left term in the matrix, you notice that there is no correction term. So that, in fact, that estimator for sigma squared is efficient. And you end up with something that literally costs you nothing. So that, in other words, misspecifying at least the marginal distribution of the U's costs you nothing in this particular case, even relative to a true maximum likelihood, even with respect to a true maximum likelihood estimator. So, in fact, this coincides, the asymptotic variance coincides with, with what you got from a normal for all except, there is a correction term, but it affects the estimator of the variance of the noise. It affects the a squared terms, but it doesn't affect the covariance between a squared and sigma squared, and it doesn't affect the variance of sigma squared. So in other words, in terms of how to interpret this, we were actually quite surprised when we found this out, and for a long time we were concerned that we had made a mistake. But it turns out that there is an explanation that involves profile likelihoods and Bartlett identities that make sense for this, for why that is. But it's a surprising result in terms of the fact that you really seem to be getting something for nothing, basically. And what this says is there's really, you could do just as well by using a Gaussian likelihood. Forget about trying to really write a complicated, perhaps Levy model with fat tails for the distribution of the noise that says sometimes the market is crazy and you get extreme price errors, or it doesn't really make a difference in this case. Let me now talk about an extension of this that involves, as I described at the beginning, randomly spaced time intervals. Now, in finance, except for the most highly liquid assets in the US, which would be currencies, some futures on exchanges, on electronic exchanges, or some stocks such as Microsoft, Intel, etc. Most assets trade at time intervals that tend to be random. So the amount of time that you wait between successive transactions is random, or at least it's not constant. Now, if you want to be serious about this, though, you probably cannot avoid trying to understand what is the relationship between the amount of time you wait between transactions and the past path of the price. Because, when things move a lot in price, the transactions tend to come about. Now, that's a very complicated model. Obviously, from just what I just described, you realize that you're losing the Markovian nature. You're quickly losing the Markovian nature of the price if you start drawing the times conditionally upon the past prices. You are also losing, the simple nature of the increments as being summary statistics for estimating sigma. So you're losing lots of things. So that's not a problem that we quite know how to solve, and it's not quite clear even that we have a good model for what is the dependence between the deltas and the prices. So instead, we're going to make an assumption that is not really realistic, and we're going to assume that they are random and that they are IID independent of the price process, the W that drives the price process. And that's clearly not a great assumption, but it's really an interesting research topic for, to the extent that there are PhD students in the room who might be interested in research ideas. That's certainly an interesting research topic to think about what is the dependence between the deltas and the x's and what are the consequences for those type of estimators. Now, so we're going to simply assume that you're drawing random numbers, and sometimes you wait 2 seconds, sometimes you wait 5 seconds, sometimes you wait 15 seconds, sometimes you wait 1 second, and that's drawn from a random distribution with some support on the positive real line. Okay? And what we're going to do further to get an explicit solution is use a time-honored trick in this business, which is to look for a solution that is a small deviation around the expected value of the deltas. So we're going to say, look, yes, those deltas are random, but they're not too random. Okay? So in other words, what we're going to do is we're going to say, okay, so I have those deltas, those time intervals, and let's say on average I wait 5 seconds, but then sometimes I wait 4, sometimes I wait 6, sometimes I wait seconds, 7, sometimes I wait 3. But on average, I don't have a distribution that is really, really widespread. So I have a fairly tight where constant. Well, now you take that formula I gave you, but you just plug in instead the expected value of deltas. Okay, so it's not the expected value of the A-var, it's the A-var evaluated at the expected value. And then there is a correction term, which is proportional to the randomness in deltas, as you might expect from a Taylor series. Interestingly enough, the term is not at the first order, so it's a correction in epsilon squared. So if epsilon is not too big, that actually isn't going to be a very large correction term. So that's, and then there are expressions in the papers for A0 and A squared. Okay, a further extension involves the presence of a drift coefficient. What if you have a drift you're trying to estimate? That's not a very interesting one fundamentally. Because effectively it's the kind of things that would be very difficult to estimate at high frequency, so I'm not going to spend too much time, but the same thing happens. You can sort of do the same calculation. Let me give you another calculation now that is perhaps more relevant, and that's a situation where now you're interested in the situation where your noise is not IID. So now you're thinking about a situation where your noise is itself autocorrelated. And to get an explicit calculation, we're going to assume a particular model of autocorrelation for the noise. So we're going to assume an Ohsta-Uhlenbeck process for the noise, which means that the noise is mean reverting around 0 in this case, but it's very highly autocorrelated. And that's kind of a different economic model from the one we had before. The one we had before, the noise was IID. So you trade, you get a price with some random error. Then you trade, you get a different price with a completely independent error. With this model, you trade, you get an error, but then you trade, you get an error that's going to be close to your error. So in other words, that would capture things where you have positive autocorrelation or serial autocorrelation in returns that might come from, for example, a situation where you have a large trader who splits up an order among multiple market makers, for example. So say you want to transact 100,000 shares, you get 10,000, you get an order for 10,000, you get an order for 10,000, you get another order for 10,000. So you may get successive transactions that are on the same side of the bid-ask spread. So you might get positive errors in a row, and then things mean revert, and then you get negative errors in a row, and things of that kind. So it's a different model. The importance of that now is that if you think about the result before was driven by the fact that no matter how small the interval between two successive transactions, you still get a variance 2a squared for the log return, which is independent of delta. If you draw two random numbers independently of the amount of time that has separated the prices, you're getting a certain variance in between them, which is 2 times the variance of each one, because they are IID. That's the variance of the difference, because the log returns depend upon the difference between the U's. Now, when delta is small, the difference between the U's also becomes small. And in fact, instead of being of order 1, the variance of the noise in the log return now is of order delta. So it's actually, the variance is now of the same order as that of the price signal. So with this model, in a way, the noise is not as extreme as before. When delta goes up, when delta goes down rather, when the sampling frequency goes up, the noise is of the same order as the price variation. It's no longer swamping the price variation. And that's why that's sort of model is sort of interesting in that regard because the noise is not as bad in this particular case. And in this case, indeed, you see that the root mean squared error does not explode when delta goes to 0. Whereas before, the root mean squared error exploded when delta went to 0. Now the root mean squared error has a finite limit. However, what you see in this case also is that the root mean squared error, if you do a Taylor series in delta and delta going to 0 and t going to infinity, you see that the root mean squared error starts by declining when you start at delta equals 0 and you first increase delta. The root mean squared error first goes down. In other words, the derivative at 0 is negative. The derivative with respect to delta at 0 of the root mean squared error is negative, which means that the first order effect is not to sample as frequently as you want, and that there will be indeed a minimum in the root mean squared error, i.e. an optimal sampling frequency. So even though it's not as extreme as before, the thing doesn't blow up, it still starts by declining first when delta goes to 0. And as a result, there's an optimal sampling frequency, which is again finite. But what I wrote here is that this type of noise is not nearly as bad as IID noise, because it doesn't make your root mean squared error blow up. And you see that from the fact that the variance of the increments doesn't blow up. And in the data, it's possible that sort of both type of noise are going to be present, especially for heavily traded assets. So if you look at at Intel here, what you see is that you see a pattern of autocorrelation that is more complicated than the simple MA1 pattern that I showed you. And indeed, there are lots of bid-ask bounces, which means that you buy on one side and you sell on the other, you buy on the other, you sell, you buy, you sell, you buy, you sell. And that generates this oscillating pattern, which tends to die out after 10, 7, 8, 9, 10 transactions, but it's quite clear in terms of what the measurement error introduces. You still have the big MA1 effect at the first order, but then after that, things do not completely disappear. Now, finally, it's possible to also deal with noise that's correlated with the price process by simply replacing in the log return in the matrix, replacing the terms with a more complicated model. I'm not going to spend too much time on this. I'll just let you read it in the paper if you're interested. Okay, let me move on now to the non-parametric or stochastic volatility case. So it's exactly the same problem, but what we're interested in doing now is estimating the quadratic variation of x. And that's the object that's denoted with those triangular brackets. Okay? So now, sigma is a stochastic process. And what we're trying to do is estimate the integral from 0 to t of sigma squared dt. And the model is dxt equals mu t dt. If you want, you can forget about the drift. But it's sigma t dwt, basically. So that's a stochastic process. And we're trying to estimate that quadratic variation over a fixed time period t. So now, of course, we no longer have asymptotics in t. So t is fixed. We have 1 day, 1 week, something like this. But of course, we will still be trying to sample more and more frequently in terms of trying to estimate that object. And so the asymptotics are still going to be with delta going to 0. Now, the usual estimator that people have used, so x is the log return, is again the realized volatility for this problem. So and that's what I will write down with square brackets. So I'm trying to estimate the triangular bracket quantity, and I can use the square bracket, which is the sum of squared log returns. It's the same thing as before. The only problem now is that, in fact, things can be substantially more dangerous in this situation than when sigma was constant and you could let t go to infinity. The thing is, when you let t go to infinity, you had the luxury of going to a finite sampling frequency asymptotically, and you still got things that work. Now when t is finite and sigma moves, things are a lot worse. And in fact, that realized volatility over t finite and delta going to 0 is converging to something else altogether. it's not at all converging to the quadratic variation of the process. Instead, it's converging to 2 times n times E of u squared, 2 times n times the variance of the noise. So it's really estimating the variance of the noise, basically. So you're thinking you're estimating the variance of the signal. Instead, you're estimating something that blows up like the variance of the noise and has nothing to do with the object of interest, which is the quadratic variation. So said differently, the noise swamps the variance of the price signal, and you're in trouble. So what we show is that if you ignore market microstructure noise, when the volatility is stochastic, you end up with this distribution. Now, what I mean here by the estimator y all, remember that y, those are the log returns. I was using x and x tilde before. In this paper, we used y. So y are the log returns. So y is the observed log return. So y with square brackets, that's the realized volatility calculated with the observed log returns, which contains the noise. And by all, by the superscript all there, I mean that you've used all the data. So you have very, very high frequency data, you've used all of it. So you've squared log returns every 5 seconds, for example. Well, what you see in this case is that you have bias, and that the bias dominates. Because when n goes to infinity, when you're sampling more and more frequently, the bias blows up. Forget about the variance, it doesn't matter. The bias completely dominates. So what you get is effectively something that does not converge to the object of interest. Because the object of interest is of order 1 in probability, that's the quadratic variation you're going after, the brackets, the triangular brackets, but the bias due to the noise blows up on you and you're out of business. So the bias draws everything else. So clearly, this is a bad idea. Doing that estimator is a bad idea, and no one would do that. What people would do instead is what we call the fourth best approach, which consists in sampling at an arbitrary frequency. So now you say, okay, fine, I realize that n, you don't want n, the largest n you can, because that really kills you. You see, even if the variance of epsilon squared is small, if you take n to be really, really, really large, you take a small number, you multiply it by a big, big, big number, well, that's big. Okay? Small multiplied by big, big, that's big. Okay? Big multiplied by small, small, that's small, but. So what people end up doing is using the estimator YY sparse, where instead of using the largest n you can, you sample at a sparse frequency. So you sample every 15 minutes or every 30 minutes or something of this kind, which might be coming from 5-minute returns or something like this. Now, if you have data that are sampled every 1 second, yes? Absolutely. Effectively, we'll end up doing something very similar to that. That's why I'm only at the fourth best now. That's right. Yes, well, that's pretty much what we'll end up doing. Yeah, no, that's just fine. So let's say you have 1 day's worth of data. 1 day in the US, that's 6.5 hours for a stock. The market opens at 9:30 in the morning and closes at 4 p.m. So that's 6.5 hours. That's 23,400 seconds. If you wondered where that number was coming from, that's 6.5 hours every 1 second. And if you now sample every 5 minutes, then how many 5 minutes interval are there in 6.5 hours? There are 78 of them. Okay? So you end up with 78 increments. You square them. And what have you done? What you've done is you've thrown away 299 out of every 300 data points. Okay? And if you are really in a church, now is a good time to ask for forgiveness. Okay? Because at that point, you know, throwing away so much data is not something that your statistics teacher will let you get away with. Okay? So it's not a good idea. So what you end up with in this particular case is something where it's better than suddenly being naive about it and saying, I'm going to sample every 1 second no matter what, because what you get is really, frankly, garbage out of it. You're just getting 2 times n times the variance of the noise, but it's not great either. Now, what's the third best? Well, certainly, let me show you first what happens if you did that. What happens if you do that is, if you calculate this estimator at different frequencies, what you end up with is a curve that looks like this. So this is, I'm not sure whether you can read, but I believe you have copies of the transparencies. On the x-axis, you have different frequencies that range from 5 seconds to 5 minutes. That range from 5 seconds to 5 minutes. And on the y-axis, what you get is the empirical estimate of the quadratic variation calculated at those different frequencies. Now, if the standard asymptotic theory that is written without noise were true, as delta goes to 0, this should converge to a finite limit. So instead of having a curve that blows up like this, you should have a curve that oscillates and then settles down to a limit, right? That's usually what you'd expect when something converges to a limit, and that's not what you have. You have something that blows up. So, and this is calculated from the data, by the way. This is not a simulation. This is taking the 30 Dow Jones stocks, 10 days, and averaging the result over the 30 stocks and the 10 days. So you imagine that you have 300 experiments, and you're averaging over the 300 experiments. That's kind of like mixing apples and oranges and bananas together by doing this averaging over those days and stocks. The only purpose of it is to reduce the noise in those estimates, right? By averaging over 300 numbers, you're getting something that shows you the deviation of the bias. So in other words, it's this asymptotic distribution, and by averaging, I'm hoping to kill the variance term, right? And I'm just focusing on the divergence that comes from the noise so that I can get a picture that doesn't look like this, but looks like that, like a smooth version that zeroes in on the noise. And indeed, you get what you're expecting. You get something where, as a function of delta, the object diverges. Okay? So that's what you're getting. And it's pretty clear that this diverges because, why does it diverge like this? Because delta is t over n, so n is 1 over delta. So this that basically diverges like 1 over delta instead of converging to the object of interest. Now, what's the third best approach? The third best approach consists in saying, fine, okay, I realize I have a problem, and I clearly cannot take the largest n I have in my sample, so I'm going to downsample or sample sparsely, but at least instead of doing it arbitrarily and sampling every 5 minutes or 15 minutes or 30 minutes, usually the way this is done, by the way, if you read the realized volatility papers, is what they would do is advocate looking at the calculation between 5 minutes, 15 minutes, and 30 minutes, and seeing if they don't vary too much. And if they don't vary too much, then they say the noise doesn't really matter, and then you can basically, you are basically safe. Okay, so basically it's like going to the right-hand side of that curve where that curve becomes flat. That's pretty much what you can do. Now, one thing you can do, at least if you want to approve that, to take that approach, is now that you can do that calculation, is simply determine optimally what is the optimal sampling frequency from a root mean squared error, in a bit like in the parametric case. And you get an answer which looks a lot like the parametric answer, and gets you an optimal number of observations to use, and that's that. Okay? So that's the third best. If that's what you want to do, that's the third best. The problem is that this still involves throwing away a lot of data, and as I've repeated a few times, this is not a good idea. Yes? Yeah, this one? Mm-hmm. So what we have in the paper is we give you an estimator of that in the paper. But in any event, we are not arguing for implementing this. You know, I'm only at the third best for now. But if you really want to estimate this, you have that. You have that. If you remember, the formula in the parametric case involved a sigma fourth over a fourth. Well, a fourth, that was in the constant case, that's an estimator of E of u squared squared. And sigma fourth, that's an estimator of that integral, and then you get the t to the 1/3, same power as before. So you really get very much the same. You really get very much the same. It's the same natural extension in the stochastic case of what you would have done. Notice this, of course, that this n star is sample path dependent. It's a random variable because sigma is random, so this would be calculated on each random path separately. So the second best approach involves doing something else, because you clearly do not want to throw away the data. So here is the idea. The idea is actually quite simple, and it's based on subsampling. So what is subsampling? Okay, subsampling starts by saying, okay, fine. I realize I have a problem if I use my data every 1 second. Clearly, I have a problem there. So what I'm going to do instead is I'm going to downsample and sample, say, every 5 minutes. Because I know this reduces the bias quite a bit, right? You saw it from that plot. The bias gets killed quite rapidly as the sampling frequency increases. So I'm going to sample every 5 minutes, but I'm going to create a grid of observations in such a way that I'm going to start at the first observation, then wait 5 minutes, then wait 5 minutes, then wait 5 minutes. Then I'm going to start at the second observation, which is 1 second later, wait 5 minutes, etc. So I have effectively 300 ways of doing that in my entire sample, right? So in other words, out of my entire sample of 1 second observations for 1 day, I have 300 5-minute subsamples. And what I'm going to do is I'm going to calculate realized volatility on each one of those 300 subsamples, and then I'm going to average the results. Okay? Now, why do I do that? Why do I average? I'm going to average because I'm hoping that by averaging, I'm going to reduce the variance. I'm going to reduce the variance of each realized volatility estimator. So I have 1 day's worth. I'm calculating 300 different subsamples over that 1 day, and then I'm averaging the results. So I create those subgrids just like I've described them, and I'm going to average the results. And to the extent that by going to 5 minutes, you're reducing the bias, you're going to retain that. Because the average is an average of 5-minute samples. It's not an average of anything at higher frequency, but it uses all the data. So in other words, the estimator is YY average now, and YY average is the average over the K subsample. So I have K, which is 300 subsamples. It's the average over the K subsamples of YY calculated over the kth subsample. So I have little k going from 1 to capital K. In this example, you'd have 300 of them. And what you do is you average those estimators. And what do you find? What you find when you calculate that is that the distribution looks very much the same with 2 main differences. One of them is highlighted in red. And what you see is that in the bias term, the bias term now is proportional to n bar. And what's n bar? N bar is the average number of observations in each subsample, because they don't need to all be equal. In my example, you have 300 subsamples of 78 observations each, instead of 1 block of 23,400 observations. So now your bias is proportional to 78 times the variance of the noise, instead of being proportional to 23,400 times the variance of the noise. So now it's no longer big, big times small. Now it's more like big times small, or perhaps even big times small, small. Okay? So you've kind of really reduced, the bias is still there, but you've reduced the bias. By doing that, you've also reduced the variance by a factor 1 over k. Unfortunately, I didn't highlight it in red. I'm sorry for that. But if you look at the total variance, there are two terms in the variance. There's one that's due to the noise and one that's due to the discretization. And in the one that's due to the noise, you gain a factor 1 over k, just as you might expect from the averaging that took place. So you look at this and you say, okay, fine, that's clearly better. That's clearly better than doing the other things separately. The problem is we still have noise. We still have noise because we still have a bias term. And now we're going to introduce another idea, which is bias correction. In order to do, now we can do that because now the noise term is something that is under control. It's actually smaller than this, it's actually smaller than it was before. And the idea now is to basically realize, so that's just basically, summarizing what I just said, that the bias is now smaller because it's proportional to n bar, which is, in my example, 78, instead of being proportional to n, which is 23,400. So the bias is much smaller. But now, here is one idea to do bias correction, and that will be the final refinement to this. So the bias of this is equal to that. Now remember what happens if you do the very naive calculation I started with the fifth best, where I took all the data, threw them in there, and calculated realized volatility from there. The bias of that was 2 times n times the variance of epsilon. Now, if I want to do asymptotics, and I promise to calculate my grids in such a way that k goes to infinity, then n bar over n goes to 0. Because I have k grids, each grid contains n bar observations, n goes to infinity, k goes to infinity. All right? If I let the number of grids increase as I sample more frequently, then what you're going to realize is that the estimator that comes from observing, using all the data and calculating realized volatility of that is effectively pure noise. So that was really, really bad. I told you at the beginning that's really, really, really bad. But now it turns out that we're going to try to use that really, 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 really bad estimator to our advantage by using it as an estimator of the noise. Okay? So it's a bit like if you're playing tennis against a player who's really much stronger than you are. Okay? And you get really lucky and you just put your racket, and the person is really serving like a maniac, and you get really lucky and you have your racket in the right place, then the ball comes back and you could actually have a very strong return, much stronger than a normal return, simply from having your racket at the right place and being against someone who gave you a really good serve, right? And you just throw the bag back and you say, wow, okay? Well, in this case, that's exactly what's happening to us. We've got this really, really bad estimator, and all we have to do is turn around and say, okay, fine, it's a really, really bad estimator, so let's use that. Let's use that to estimate the noise by recognizing that YY all, if I sample every 1 second, I'm actually estimating the noise. And that's really what I'm doing. And so I have an estimator of the noise from this that comes from using the fifth best estimator. And now I can perhaps combine the second best estimator and the fifth best to use the fifth best as a means of bias correcting the second best. And that gives us this, where if you remember the bias in the average estimator was proportional to 2n bar, the variance of the noise, but now we're using YY all to estimate n times the bias of the noise. So if you subtract minus n bar over n, YY all, you now have your estimator, your estimator of the quadratic variation. And you notice that if you do that, then what you end up with is something that looks a lot like the previous distribution, except that there is a piece that was left blank. That's the piece where I used to write the blank, or the bias, rather, and now it's blank. Okay? So where the bias used to be, now that's blank, which is why you can now write that one as actually triangular XX with a hat, because now that's actually a consistent estimator of the quadratic variation. And that's that, and that estimator we call 2 scales realized volatility, because it's basically based on calculating realized volatility on 2 scales, a very fast time scale, so things that move every 1 second. What was the objective there? The objective there was to effectively estimate the variance of the noise. That's used only for bias correction purposes. And the slow time scale, where we're sampling every 5 minutes, and then averaging over all the possible 5-minute realized volatility estimators that's used to effectively estimate the object of interest, and then use the very fast time scale to bias correct it. So we call that 2 scales realized volatility. If you look at the asymptotic distribution, you see that it converges relatively slowly at n to the 1/6. So it's a fairly slow rate, but of course it's better than being badly biased, and there is no limit to how often you should sample. Because what's important here is that this is n, this is not n bar. So this uses all the data, and it's based on all the data. Now, the summary is again quite simple, full data set, sampling every second, use the sum of squared log returns for bias correction, that's the fast time scale. The slow time scale, sample every 5 minutes in every possible ways by lagging that way, and then calculate the asymptotic, and then calculate the average of that, and then use the fast time scale to bias correct. Monte Carlo simulations, things work really well. Things work in a really ugly way for the 5th best, but that's exactly what you want. You want the 5th best to be really bad, because if the 5th best is really bad, which is what you have down here, if the 5th best is really bad, that means it's a really good estimator of the noise. And here you see that you sort of really cut down the noise. I'm going to show you, this is what you do for the 3rd best using data. This is the way the distribution looks like relative to, for the 1st best, relative to the, in simulations, relative to the theory, so it works nicely. And here's some basic data analysis that looks at Intel. And what you have in, with the dashed line here, the orange dashed line is realized volatility calculated at all those different frequencies. And what you see, of course, is that it's a very noisy estimator. Realized volatility is very noisy. So when people tell you, I use 5 minutes, but I could have used 10 minutes, well, maybe, but there's a lot of arbitrariness in using one number versus the other, because it's a very noisy estimator. This is the estimator. This is TSRV. And of course, what you end up with is you end up with something that looks like an average of these things that's been bias corrected, which is basically what that is. This is what happens around the 5 minutes frequency. So again, fairly volatile realized volatility estimators. And then what we have here, and I probably won't talk about that because this is sort of getting into some of the details. What you have is you have really dependent market microstructure noise. What if the noise is not IID? That's what you end up with. So let me just skip this. There is a refinement to allow for this. And the last thing I'm going to show you is a natural extension of this, which goes from 2 scales to multiple scales and has the effect of increasing the rate of convergence from n to the 1/6 to n to the 1/4. And n to the 1/4 you can actually show is the optimal rate, going to n to the 1/4 is the optimal rate you would get in the parametric case. So to conclude, in the constant volatility case, in the presence of market microstructure noise, it's optimal to sample less often than would otherwise be the case. A better solution, however, is to model the noise explicitly using likelihood methods, and then you can use all the data and you can appropriately correct for it. And again, in that case, it doesn't really matter if you have the right model or not. You will get the right answer, even if you misspecify the model for the noise. In the non-parametric case of stochastic volatility, matters are much worse, because realized volatility estimates the variance of the noise. It doesn't estimate the signal, but then you can turn that to your advantage as a bias correction device by subsampling and averaging and using that fact to create a bias corrected estimator of the integrated volatility. Which means that thinking about the noise in the data is actually useful, because these things are really real effects. I mean, when you saw the data analysis I showed you, there's no question that there is data in, that there is noise in the data. So that coming back to Hermann Hirschfeld's 1980 paper, in this case, really the noise is a first order consideration in those high frequency data. It's not something that you can just say, well, you know, data are data and they're noisy. No, in this case, they are really first order considerations. And so this suggests that, you know, attempts to incorporate market microstructure noise should have beneficial effects. And the final message that perhaps unites those two papers in terms of basic statistical principles is that anytime one has an instinct to throw away data, there's usually a better solution around the corner that uses all the data. And I think that's a fairly general message in whenever data is involved. I think throwing away data is usually not a good idea, basically, and that it's usually possible to do better than just throw away the data. So that's it for the first lecture on estimating volatility with noise. I believe we have a break now. Okay, thank you.